Hello and welcome to Simple Mind Space. Today's topic is the FTX disaster and how it all unfolded. Imagine being a multi-billionaire and losing everything in a weekend. It sounds pretty impossible, doesn't it? Well, that's precisely what happened to Sam Bankman-Fried, the CEO of FTX, the second largest crypto exchange in the world. Sam was considered a financial whiz kid, the golden boy on the covers of Fortune and Forbes magazines. He had a $26 billion net worth, rubbed shoulders with celebrities like Steph Curry, dined with the likes of Sia, Jeff Bezos, and Leonardo DiCaprio. Big-name investors like BlackRock and SoftBank were backing his vision. But things weren't as they seemed. Behind the glamorous facade was a messy, ethically questionable operation running out of the Bahamas. Sam's empire, far from being a sophisticated financial institution, was more like a group of 10 romantically involved young crypto enthusiasts running a shady operation, seemingly exploiting regulatory loopholes in the Bahamas. The fallout from FTX's collapse triggered a chain reaction, leading to the downfall of over 100 affiliated companies and wiping out countless people's savings. It was a story with strange yet real ties to American politics, the war in Ukraine, and Enron. It had the intrigue and intensity of Theranos, but with a collapse as rapid and impactful as Lehman Brothers. Let's delve into the wild story of the fall of FTX. At the heart of this story is Sam Bankman-Fried, the man with the unassuming look and tousled hair. Born in 1992 in California, he came from a family deeply rooted in academia and politics, with both parents holding prominent positions in the legal and political spheres. After graduating from MIT in 2014, Sam joined Jane Street Capital, a New York trading firm. It was here that he realized the immense potential for making money by trading cryptocurrency. He discovered a loophole where he could buy Bitcoin at a lower price in America and sell it for a higher price in Japan, sometimes moving up to $25 million a day. In 2017, he used the profits from these trades to establish his own company, Alameda Research. Alameda was primarily comprised of Sam's college friends from MIT and former colleagues. Little did they know this firm would play a central role in the eventual collapse of his empire. Sam, driven by the philosophy of effective altruism, aimed to have a positive impact on the world. He even portrayed himself as a down-to-earth billionaire, choosing to drive an ordinary Toyota instead of a flashy supercar, a calculated move to project trustworthiness. However, his actions would tell a different story. In reality, he owned a $30 million mansion in the Bahamas. Sadly, many social media influencers fell for his carefully crafted image of humility and promoted his companies. Sam's next venture, FTX, a cryptocurrency derivatives exchange, was launched in 2019. Think of an exchange as a marketplace for storing and trading different cryptocurrencies and tokens. Naturally, the exchange charges fees for these services. FTX also offered discounts to clients who stored their money in a token called FTT, a token created by FTX itself, and the token that would ultimately be at the center of this entire debacle. The group of friends running Alameda Research in the Bahamas were described as a gang of kids by Fortune magazine. These kids, many of them former co-workers from Jane Street and MIT graduates, were known to be romantically involved with each other, creating a tightly knit inner circle. Caroline Ellison, an inexperienced CEO who openly lauded amphetamines on Twitter, was also a part of this group. Her unusual views on polyamorous relationships, advocating for a hierarchical structure, were revealed in her Tumblr posts. Alameda, although seemingly just a bunch of friends hanging out in the Bahamas, was essentially operating as a crypto hedge fund. They facilitated trades, matched buyers and sellers, and promised investors an enticing 15% annualized fixed-rate return with zero downside. In reality, this was an impossibly good deal, and as later reported by the Wall Street Journal, the firm was using customer deposits from FTX as loans for their risky trades. This is a clear violation in traditional finance, where customer funds are strictly segregated from company funds. To make matters worse, there was a concerning lack of transparency and oversight at both FTX and Alameda, with Sam and his close associate, Gary Wang, controlling the core systems without any real accountability. FTX, meanwhile, became increasingly involved in politics, becoming a partner of the World Economic Forum and facilitating cryptocurrency donations for Ukraine. They even built the infrastructure for converting these donations into fiat currency deposited at the National Bank of Ukraine. This move further intertwined FTX with geopolitics. As FTX grew, its brand recognition skyrocketed. They secured promotional deals with stars like Tom Brady, Steph Curry, Naomi Osaka, and Larry David, who reportedly received equity in FTX in return for their endorsements. It was a classic tactic to boost credibility and attract investors. They even had their names on a UC Berkeley stadium, an NBA stadium in Miami, and partnerships with the Golden State Warriors and the Mercedes F1 team. A lesser-known figure within FTX, Ryan Salam, also engaged in political maneuvering, donating $23 million to Republican politicians, aiming to secure political influence for the company. All of this while FTX lacked a traditional board of directors, with decision-making power concentrated in the hands of Sam, a single employee, and a lawyer. However, a shift in the economic environment marked the beginning of FTX's downfall. In the second half of 2022, as inflation surged, the U.S. Federal Reserve raised interest rates, leading to more expensive loans and making investors more cautious. Risk assets, including cryptocurrencies, took a nosedive. Amidst this turmoil, FTX stepped in to bail out struggling crypto firms by buying their assets at record discounts, a move that appeared risky but was deemed manageable because of Alameda's supposed abundance of capital. Behind the scenes, however, Sam and Alameda were incurring massive losses from bad trades and these bailouts. Sam's carefully constructed image began to crumble when CoinDesk published a report revealing Alameda's unhealthy balance sheet. It became clear that a significant portion of Alameda's assets were held in FTT, the token created by FTX itself. In essence, Sam had created a token, artificially inflated its value, and then used it as collateral for funding his projects. This was a highly questionable practice. As the crypto market continued to decline, Alameda's illiquid assets became a major problem. Concerns arose about FTX's actual financial stability, creating the perfect opportunity for CZ, Sam's main competitor and the CEO of Binance, to step in. CZ, already holding $2 billion worth of FTT tokens acquired through his early investment in FTX, decided to strike. His single tweet announcing Binance's plan to dump their FTT holdings sent shockwaves through the crypto world. This move triggered a massive sell-off, causing the price of FTT to plummet by 80% in just 2 days. Consequently, FTX's reserves dwindled rapidly. Panic ensued as it became clear that FTX didn't have enough funds to cover withdrawals. It was a classic bank run in the digital world. With a staggering $9 billion in liability and only $900 million in liquid assets, FTX was facing a massive $8 billion shortfall. Desperate to prevent a complete collapse, Caroline Ellison, the CEO of Alameda, reached out to Binance with a plea for help. An agreement for Binance to acquire FTX was reached. However, after examining FTX's books, Binance backed out. The reported $8 billion shortfall and the realization that a significant portion of Alameda's assets were held in FTT, essentially a worthless token created by Sam, made the deal unfeasible. On November 11th, Sam resigned from FTX and announced that both FTX and Alameda were filing for bankruptcy. This news sent crypto markets plummeting. To add insult to injury, it was soon discovered that $1 billion worth of customer cryptocurrency had vanished from FTX's accounts, presumably due to a hack. Countless companies were affected, including Sequoia Capital, one of FTX's biggest backers, who had to write off their investment as worthless. A teacher's pension fund in Canada also lost almost $100 million invested in FTX. Amidst this chaos, rumors circulated that the hack was an inside job orchestrated by Sam through a secret backdoor in the system. When questioned about the missing funds by Reuters, Sam simply responded with 3 question marks. U.S. and Bahamian authorities are currently investigating FTX and its affiliates, and there is talk of extraditing Sam to the U.S. for questioning. This entire debacle highlights the importance of due diligence in investments, particularly in the volatile world of cryptocurrencies. The FTX story is a stark reminder that even in a bull market, there are bad actors ready to exploit unsuspecting investors. Remember, always invest responsibly and only put in what you are willing to lose. If you enjoyed this podcast, please like, share, and subscribe to Simple Mind Space for more deep dives into the world of finance, technology, and business. Thank you for listening.